If you're a millennial or Gen Z attorney, choosing the wrong employee benefits plan could cost you over $1 million over your lifetime. Open enrollment is coming up for a lot of people, and if you make the wrong election, you'll have to wait a year before you can make changes. And one of the most important decisions you can make is choosing between the copay and the high-deductible HSA plan. In this video, I'm going to break down the numbers and show you the true costs of each plan so you can make an informed decision. Hey guys, I'm Joel. I'm your Big Law Money Guide. I'm married to a former Big Law attorney, and I've educated hundreds of attorneys on various topics of personal finance. So follow me if you want to make smarter financial decisions. All right, let's dive into it. So for those of you who aren't familiar, let me explain the main differences between a copay and a high-deductible HSA plan. The main difference between the two plans is in their structure and how they're designed. With a copay plan, you pay a predetermined amount every time you go to the doctor. It's called a copay. So if you go see your primary care doctor for an infection or something like that, you may have to pay a $40 copay. And if you go see your dermatologist, you may have to pay a $60 copay. It's a predetermined amount. With the high-deductible HSA plan, you have to pay the full cost of the visit until your deductible is met, at which point you start paying only a portion of each bill. So what that means is the cost of the copay are much more expensive than the premiums of the high-deductible plan. Also, one of the big differences is you're only eligible to contribute to a medical flexible spending account versus the high-deductible HSA plan. Well, you're eligible to contribute to a health savings account. We'll talk about those in a little bit. So those are the main differences between the two plans. So now that you understand the main differences between the two, let's look at actual numbers and the impact of choosing the copay versus the high-deductible plan. What you see here on the screen is a calculator I created to compare the true net out-of-pocket cost of each plan. So here I'm factoring everything from the premium that you pay all the way to the tax savings associated with each plan. By the way, you can download a copy of this calculator by clicking the link in the description below. So before I dive into the numbers, let me explain the assumptions that I made that went into this comparison. So first of all, here we are assuming it's a family of 4 with 2 young dependent children. I just took my own personal experience. I have a 6.5 and a 4.5-year-old, so it was just easy that way. So what you can see here on the assumptions tab is the medical care assumption for this family. Again, speaking from personal experience, so you can see an estimate of the number of visits for each type of visit. So maybe, 5 specialist visits, 5 urgent care visits, and then maybe 1 emergency room visit. And you can see for the copay plan, well, these are predetermined amounts. So that would be their cost out of pocket that they would have to pay. With the high deductible HSA plan, again, they have to pay for the full amount of each visit until they've met their deductible. So in this case, they actually did not hit their deductible for that year. The major medical cost assumption, we'll talk about that in a little bit, but this is assuming there was something major, maybe the birth of a child or an extended stay in the hospital. We'll discuss that in a little bit. Here, this section you can see is your health plan information. You can get this information from your employee benefits package. Again, remember this assumption, this comparison. I work with a lot of big law attorneys, so I used an employee benefits package from a big law firm. Now, keep in mind, if you're not in big law, you may have better benefits than this. Big law firms typically don't have the greatest benefits. The premiums might be lower, the deductibles might be lower. So just keep that in mind. Every benefits plan is different. But for this plan, I assumed a $2,000 deductible for the copay, $6,750 for the HSA, and then the out-of-pocket max. So this is the max you can expect to pay out of pocket, and then the premium, right? What you have to pay to get to those plans. And then the other assumptions are, well, first of all, are you on an individual plan or family? This plays into the contribution limits that you can, regarding the health savings account, the HSA. Speaking of the HSA, one of the big components of an HSA that a lot of companies and law firms do is they actually put money into your HSA on your behalf, kind of like a match for your 401k. Every law firm and company is different. For this one, I assume that they put $1,000. Now, the difference between HSA match and a 401k match is with the 401k, you can contribute yourself up to the max limit. And then whatever your employer matches on top of that, it doesn't matter as long as that's below like $70,000. With the HSA, the combined between the employer and employee has to be up to the limit. So that's why it's broken down here. For 2026, the limit for the HSA contribution is $8,750. So because the employer is contributing $1,000, that means the employee can only do $7,750. So that's the assumption here. Now, just a little bit ago, I mentioned that if you opt for a copay plan, you cannot contribute to an HSA. Well, vice versa is true. If you opt for the HSA plan, you cannot contribute to the FSA, the flexible spending account. So that's why I assume here now with the main difference between the FSA and the HSA, so flexible spending account, health savings account, is the FSA, you must use the money inside that account by the end of the year, or there's a little bit of a grace period, but by the end of the year, otherwise you forfeit that money. So you kind of have to estimate how much you're going to be needing for the year. That's what that number is. It's just an estimate of this family assume that since they have copays, this is what they can expect to spend on medical costs. And keep in mind, the definition of medical costs is pretty broad for FSA and HSA. So like it could be for glass frames, could be for over-the-counter medications, or you name it. So it's pretty broad. So that's the assumption, and that's going to play into the tax benefits, which leads to that. Here, I assume somebody that lives in a state with no income tax, but if you do live in a state with income tax, always put your marginal tax bracket here. So that means that your last dollar is taxed at that rate. So I just assume a 32% tax bracket here. Let's dive into the actual scenario. So the first scenario is just a normal year. So basically what you see here, that's what I assume for scenario one. So you can see kind of a duplicate of all the deductible numbers, the out-of-pocket max, annual premium, and then your out-of-pocket medical costs. Well, it's simply these numbers, right? These two numbers for each plan. Again, neither for neither plan, the deductible was met, so that's why you're seeing that. So you can see the total cost before tax savings. Well, it's just your out-of-pocket medical cost plus the premium that you paid. That's this column right here. Now let's get into tax savings. Well, flexible spending account and HSA, health savings account contributions, are deductible. So you can save on taxes there. Your premiums that you pay are also deductible. They're pre-tax. So that means you're saving. So the fact that you're paying a higher premium for the copay plan actually is helping you lower your taxes. So we have to factor that in. So that's what you see here in the tax savings. Also, because the employer is putting $1,000 on your behalf in your HSA, that's free money. So I do factor that into that's $1,000 that you don't have to contribute. So here you can see in column I the true net out-of-pocket cost of each plan. So even though the HSA, the high-deductible HSA plan, had $5,000 of out-of-pocket costs throughout the year, because of the lower premium, the higher tax savings, or the tax savings, and the employer contribution, there's actually a net cost, net savings of about $3,600 between the two plans. So something to keep in mind. Now, I mentioned that what if there's a bad, really expensive year? Not necessarily bad, it could be the birth of a child, which is really exciting. What would that look like? So I built a second scenario that shows an expensive year. Again, I assumed the $10,000. You can make that $20,000, $50,000 for a very catastrophic year. For this example, I used $10,000. So the only really difference is the out-of-pocket medical costs. In both instances, each plan met their deductible. So that was factored in here as well. But they were both below their out-of-pocket max. So you can see the total cost before tax savings, then the tax savings, HSA, employer contribution, and then the true net cost, which again is around the same thing. So it's a very interesting to see that even with a large medical expense, the HSA is still net cheaper than the copay. So that's something to keep in mind. At this point, you can see that even in really expensive years, the HSA could come out to be net cheaper than the copay plan. But the true benefit of the high deductible HSA plan is not just it could be cheaper. It's also the ability to contribute to an HSA. So the HSA is a very powerful tool because it allows you to invest the money that's in it. A lot of people make the mistake of contributing to their HSA and then turning around and immediately using that money for their day-to-day medical expenses. That's a mistake because you don't let the money inside the HSA grow and compound on itself. And because of the tax benefits, you could take that money out tax-free in retirement. So let me show you what I mean by that. So here you can see the same example as we were looking at earlier. If you want to look at it just from an individual standpoint, you can as well. But from a family standpoint, in 2026, the HSA limit is $8,750. We mentioned that the employer is contributing $1,000 on your behalf. So that means that you personally can only contribute $7,750. This is assuming a 30-year-old or 35-year-old contributing over a 30-year period. So you can see the total employee contributions and total employer contributions over that period. Now, keep in mind that just like your 401k limit goes up each year, like this year it's $3,500 your 401k. Next year it might be $24,000, right? There's always a little bit of an inflation adjustment. Well, same thing with the HSA. Now, it's only been around for about 22 years, and the average increase of the limits has been around call it 2.5%. So I assume that was going to continue over the next 30 years. So, in 30 years, the limit, it will not be $8,750. It'll be a lot higher than that because the limits go up. So I did assume that in my model. So that you can see the difference, the total contributions between the employer and the employee. A rate of return, this is assuming an 8% rate of return on the investments that are inside the HSA. And the projected balance after 30 years is $1.3 million. So that could be a nice pool of money that you can use for your retirement. Now, keep in mind, it has to be used for medical costs, right? Otherwise, you have to pay the taxes, and if it's before age 65, you have to pay a penalty. But the nice thing is medical cost doesn't just mean cost of the doctor. It could be in retirement, it could be Medicare premiums. It could be long-term care costs. It's pretty broad what you can do. So having that big pool of money for your retirement medical expenses is going to be a big plus. And the green number here is that tax-free growth, that tax advantage I was telling you about. So you only put $337,000 of your own money into this, and it's grown basically to 1.36 million. So that's over $1 million of tax-free growth. So that's money that the IRS will never be able to get their hands on if you use it for medical expenses. As you can probably tell, I'm a little bit biased towards the HSA plan, but that doesn't mean it's always the right plan to select. I'll give you an example. I was working with a client a few years ago, and she was hesitating between the Copay and the HSA plan, and I showed her those numbers. And obviously, the HSA came out on top. It was cheaper, and she would be able to contribute to the HSA and everything. But she told me, Joel, if I have to pay $175 every time I had to go to the doctor, keep in mind she was seeing a therapist, so she had to go pretty frequently. She said, I will not go. I will literally not go. And I told her, your health is a lot more important than be able to contribute to an HSA. Pick the Copay plan. And that way you only have to pay, $50-$60 every time you go. And she selected that, and she never looked back, right? So my point here is that because it makes sense in a spreadsheet doesn't mean it always makes sense in real life. All right, guys, that's all I got. If you found this video helpful, please don't be afraid to share it. And if you're new to this channel, please give me a follow, Big Law Money Guide. And if you'd like to get an assessment of your employee benefits, feel free to schedule a free introduction call with the link in the description below. Thanks for watching.